Wagwan! My name is James Brown.
My name is Kofi Safo.
And together we are the
Two Rasta Boys.
Alright, so welcome. Two Rasta Boys, our main aim is to make sure you understand all these financial terms that your finance minister is telling us.
And then, if you cannot understand, we break it down into simpler versions in a very funny way for you guys to understand and laugh with us.
Yes, you understand. Okay, so today, what are we discussing? We are discussing
bonds.
Like James Bond, but with an S. Where did bonds start? According to the history books, long ago in a land called Mesopotamia. That one, if you don't say it well, you end up biting your tongue. Mesopotamia.
Mesopotamia.
Yeah. What is it?
That's how the Hebrew said.
Mesopotamia. Yeah.
And the gas.
No, there's an H sound somewhere. It will disappear.
Yeah.
So in ancient Mesopotamia, they used to lend people money, or were they using money?
No, I don't know. But maybe I don't know. Stones, gold.
They were lending people some things,
yeah.
And then they will pay back later. And they were the people that discovered iPads long before Steve Jobs. They were using clay tablets. They write it down, and then at a later time, you have to pay it back.
Yeah, that was iPhone 1.0.
1.0. No, this is 0.1. Before. And then later on in the 12th century in Europe, they also adopted this way of lending money to the government, to the states.
Yeah.
That's how they funded the wars. That back in the day, wars were like the ish. You have a race when you go and fight wars. So that was one of the ways that they funded the wars. The only difference was that they added the concept of paying interest to this. So you have interest on the money that you borrowed from the states.
And then I think one thing you have to note is that from the 12th century, as he mentioned, that was the first time that the bonds started looking like the modern day bonds, where in this case, you could trade it. So it means that when you lend money to the state for the wars, someone can buy the money you've lent to the state, that debt, from you, so that you can transfer it to that person. So you get a document and then you sell the debt. It's as simple. It's like in our local times, if someone gives you money, you go to Nogoku.
You go to Nogoku.
Yeah.
The gods will deal with it.
They will buy it.
Mm-hmm. We fast forward, we come to the 19th century. This setup was expanded, and that was how it was used to fund major infrastructure change in Europe. And then we come straight to the 20th century, where the war bonds were back. They came back because, why not? Let's fight some more. World War One, Two, Three. Well, 3 hasn't happened yet, but watch out. This is a brief history on bonds. So now let's get into the nitty-gritties, the technical terms. That's why this guy is here.
Oh my God. A lot of confidence bestowed upon one person. Yes. So bonds, how are they issued, right? Someone will probably ask me, what's the difference between a bond and a loan? So a bond and a loan, the difference is that a bond can be traded on the market. When I say market, it's the financial market. So
not Makola.
No Makola market. Yeah, no Mala market. Yeah. No KJT market. Yes.
Kasua market.
Yeah. With the municipality heads. Yeah,
you can't trade it there.
Yeah. Anyway, that's an inside joke. Municipality heads are, the thieves, the pickpocket. Yes. So on the market. So what happens is that a company or a government says, okay, we need money to expand, to build railways, to build roads. And how are we going to finance this money? We are going to divide this money into small bits of pieces and sell it on the stock market, on the financial markets. and different investors will come and buy, and these different investors will get to be a creditor of the company or the government. And what is that benefit? They're going to get interest from it. So basically, that is how bonds are issued. Now, there's two types of this. When the bond is first issued by the government or the bond or the company, that's called the primary issuance. So when you go and buy the bond directly from the company, from its primary issuance, then that is called an on-the-run bond. I mean, it's fresh. It just came out, right? Then on the secondary market, that is where the logo book comes in. So if I bought it from the government and probably I want to sell it, I just go to the financial market and sell it to another person who really also wants to get a bit of it. Because why would I go and get debt from someone? Because I stand to get interest from it. Yeah.
On the run. Okay. So it's like the place that used to sell chicken for us, but they are not there anymore. So, Kofi, the next thing is I'd like to know what type of bonds are available for sale.
Oh, yes, that is a very good question. There are different types of bonds. The main one, as from what we've been explaining now, is we have government bonds and we have corporate bonds. So government wants to build roads, railways. So they go into the financial market and issue. How do you know this is a government bond? They have different names for it. When it's a short-term bond, they call it treasury bill or treasury notes. If it's a okay. So maybe the government wants to pay workers quickly. They put and
then it becomes our problem.
Yes.
It becomes the workers' problem because
exactly.
they buy the treasury bills.
Yes. And then the long-term ones are what people call bonds. So the long-term bonds. So the 5-year, 10-year, they are 20-year bonds. They are 30-year bonds as well. Wow. Then we have corporate bonds. So Unilever, Nestle Ghana Limited, whatever. They also probably want to expand their business into Volta region. They want to expand it to Ashanti region. They want to make a different innovation or bring a different product line. And they need money to finance it. But then they don't want to risk their equity. They don't want their owners to lose part of their equity. So then what do? They also say, we are going for a loan. And how do they get a loan? They issue bonds as well. We have other type of bonds too. We have inflation bonds. So inflation bonds are bonds that people buy which are inflation protected.
Oh.
Exactly.
Oh.
Yes.
I see.
Yes. So what happens with a bond? When you buy a bond like 100 cedis or $100 or 100 euros.
Okay.
It means that you bought a note that the issuer of the bond is promising to pay you the face value, that is 100 cedis, at a particular date, let's say in 5 years.
All right.
So in 5 years, it's going to pay you that 100 cedis, that's the face value.
Okay.
Yeah? Plus interest, of course.
Okay.
Yes.
Okay. That's the important part. You are giving me the same 100 cedis in 5 years.
Yes. So with interest. How the interest is structured is quite complicated. We will tell you later.
That's another.
Exactly. But with inflation bond, the face value can be adjusted depending on the inflation rates.
Okay.
And so normally we have pension funds who go for this kind of inflation bonds. So that's the kind of inflation bonds that are also there. And these are normally issued by governments.
Okay.
Yeah.
Okay, that's cool. The more you know. And okay, so this one there is with everything. But we have to know everything you do involves some risk. But how much of a risk is it to purchase bonds from an entity? I've used one of the big words. An entity.
Yeah.
With your no-go feel that you've got, and hopefully you get some interest later. How much risks are involved in getting bonds?
It's the same thing when you are going to give someone a loan. You have friends that you are always ready to give them loans. Mm-hmm. You have friends that immediately you see their number, you're like,
this guy
again. Yeah. They'll tell you, I'll give it to you next week. Just next week. And then you call them next week, they'll say, when it comes, I'll tell you.
Hayeka.
So
bad debt.
Exactly. So then the first risk is credit risk.
Okay.
So dependent on who is issuing the bonds, there is credit risk.
Is this what, like in the US, they go like, oh, your credit score and those things?
Exactly.
Okay.
So when the bond is issued, part of the process of the issuance of the bond, there is a designated credit rating firm that has to assess your company's structure and give it a particular rating. So when they do that, and that is the rating listed on the bond, so investors will just go and say, okay, I want AAA bonds or AA bonds. But then the lower the credit risk, the lower the interest. So it's all like that. It's like all like
you have to balance.
You have to balance it and balance it. Yeah.
Okay.
Yeah, and then we have credit risk. Credit risk is the reason why people normally say government bonds or treasury bills are risk-free. Treasury bills are not risk-free. They are credit risk-free. That is what, like this, with this, the inverted commas, right? The assumption economically is that when the government issues a bond and you are coming to chase them and they can't pay, they will just go and print more money to pay the bond. That is the assumption. So that is why, exactly. That is why economically, people assume that it is credit risk free. But it is only credit risk free when the bond was issued in the local currency of the country. There are some bonds that are issued by a particular country but in a foreign currency. So for instance, Ghana had the Euro bond, where Ghana government issued bond on the market, but it was not in cedis, it was in euros. So that one has a lot of credit risk because the Ghana government cannot print euros. Exactly. But we also have to know that we have had governments who have defaulted on their local currency bonds. And Ghana government was also one. So we have to take note of that as well. We also have market
hard costs.
We also have market risk. So market risk is the interest that they are giving you. This interest is subject to movement in the market. Sometimes it goes up, sometimes it comes down. So that is market risk. We also have one important risk that a lot of people don't really talk about. That is what we call liquidity risk. What is liquidity risk? Liquidity risk is the risk that you might not be able to liquidate your assets in case something happens and you need money as soon as possible. Now, especially long-dated bonds or bonds from emerging market countries like Ghana, Nigeria, and other emerging market countries can be illiquid, especially in very volatile financial markets like the financial crisis, the COVID crisis, and other things. At that time, if you are losing money, you need money, and you have those kind of bonds, long-dated bonds or these emerging market bonds, it might be difficult to find a buyer. So then that has an illiquid component. So then it becomes liquidity risk.
Yes. I don't know what he said. It becomes liquid.
Yes.
Water. Your money becomes water. But anyway, so that is a few of the risks involved in acquiring bonds. Not bonds, bond. So before we leave here, we're going to just a little summary of all that we have learned today concerning bonds. So we learned that bonds are basically someone lends you money and then you tell him, I'll pay you back at a later time with interest. So that is the basic thing we learned here. And also, in conclusion, Mr. Safo, what was the conclusion we came up with?
The conclusion is that we learned about the definition of bonds. We learned that bonds are mainly used by corporates and government to meet their financial commitments. We also learned about the risk. They have market risk, they have credit risk, they have liquidity risk. We also learned about how bonds came into being. Mainly in the beginning, they only helped governments to finance their wars. That's interesting because human beings wanted to kill other human beings and they needed other human beings give them loans to kill other human beings. That is interesting. And then companies also used it to build roadways and other stuff, infrastructure. That's the conclusion that we made.
Yes. So I hope you have learned something.
Yeah.
At least something small about bonds today. And before we leave you, we have our random fact for the day.
Ooh. Yeah.
So, our random fact for the day is the same muscles.
The same process. I think
The same process you use to cry is the same process that makes your dingy. It stands attention.
Yeah,
so therefore, as a man, if you cry, there is hope for the future.
You are not a weaker man.
You are not a weaker man.
You are not a weaker man.
So
you have potential, man.
So, gentlemen, this is another way to raise ladies. Cry some more.
Yeah.
I love you.
These are the two Rasta boys. If you want deeper dives into bonds, leave some comments in the comment section, and we'll come back with the next section to give you some explanation. And these are the what?
Two Rasta boys. Don't forget to subscribe.